Good evening, friends. Welcome to the February Economy Markets and Investments update. So let me start off. So basically, on the economy, since the most recent fact was the union budget, well, the union budget was a non-event from a taxation perspective. I think it still held a lot of value from a market perspective and from the economic growth perspective. So let me spend a few minutes in taking you through. So this is the summary of the budget numbers. I'll discuss them in detail, but broadly, as you can see, we hope to become a rupees 3 trillion economy in the coming year in terms of a nominal GDP. And if you see the column from the right, there is a percentage of GDP sets and there's a percentage of year-on-year growth set, right? And you will see a little detail here. But right now, I'll draw your attention to the fact that in 2022-23, we are at 6.4% fiscal deficit. This year, we are bringing it down to 5.8, though we promised 5.9. Next year, we're targeting 5.1, though we last year promised 5.3. So that's one indication of what. The second aspect here is in terms of the tax income, right? The tax buoyancy that's been assumed in the budget. As you can see, as a percentage YOY, you are expecting next year, it's only a 13% increase in the income taxes that we are expecting. Not very rich. So the 5 points to summarize from a budget would be, first of all, the nominal GDP growth for next year is only 10.5%, right? And in FY24, the consolidation, that is the fiscal deficit coming better, is despite GDP growth only going by 9%, right? So even in a time when the nominal GDP growth didn't go that much, it was morely because of low inflation, right? And the fiscal deficit forecast, right, on the back of cuts in subsidies, spending on agri, rural, and pay, right? So FY24 low fiscal deficit has been managed because higher income tax, dividend from RBI, and they've reduced the defense and the state capex, right? We'll come a little more detail into this next, right? But I think the three trends that are very important as a takeaway from the budget are a very aggressive commitment to consolidate the fiscal mathematics, right? So this is a bit of a surprise because in an election year, you would expect them to actually take the leeway and spend the money, but they're actually talking about consolidation. So very good from a foreigner's perspective. When FIIs look at it, they'll say, okay, the country is being managed well. And this is the time when fiscal deficits all over the world are going through the roof, in America and Europe and everywhere else. Second is whatever they're spending, it's a reduced spending. Whatever they're spending, the capex proportion continues to be very good, right? And they've dropped the subsidies on food and fertilizers in an election year. Quite tough to actually say. And then they're also, depending on the states now, see the center at its level has been doing a lot of capex, but the states also have to do, because state highways, state railroads, state thing. So the government is actually trying to promote that by giving a 50-year interest-free loans to the 75,000 crores over and above the already existing 1.4 lakh crore of capex loan, right? So that's already seen a growth of 23%, right? What else should you note down from the budget? First, they have increased spending on NREGA for this year and for next year, which means the support to the rural economy till they create the jobs, they want to keep it continuing, right? That's one thing. Second is that they've used the GST compensation to reduce the market borrowing. So they are expecting the GST collections, the compensation cess to take care of. That's why the market borrowings, right? And like I said, conservative gross tax collections at 11% and spending only going up by 6%. Rural welfare schemes, they are concentrating on because that's the vote bank essentially. And where they're doing the capex is from the Ministry of Economic Affairs for new schemes. So 74,000 crores of capex, up from 56,000 crores. And they are focusing a lot on digital and infrastructure projects. Now, when you analyze this, you can see the trend lines over a long period of time. Okay. So there, when you see that, you can see that the capex, the red part, has gone from 1.7 in 2020, the COVID year, all the way up to 3.4%, whereas the revenue expenditure has been consistently coming down. That's the very good way they are managing the quality of the spending, right? Second aspect here, if you look at the capex spending as a percentage of total spending, right? So the capex spending is actually shooting up as a percentage of total, right? Third aspect here, if you look at the growth in the capex, right, as a part in the budget, it's 3.4% of the budget, right? And where are they spending this? They are also looking at incentives for the PLI. Now, why is the PLI important? The PLI is important for us to snatch exports away from China. So a lot of these areas are where China has been the major manufacturer. As you're aware, China is going through a population decrease, working age population is decreasing. The second aspect is that they're facing political challenges with the US. And the third is that their cost of labor is also gone up. So there's a wonderful opportunity for India to fuel our next decade's growth through taking exports from America to America, from China to Europe, China, and grabbing that. So naturally, we need to provide some level of incentives. So the whole production link incentive, which is what PLI is targeted. Which are the main areas where they are projecting the spend in terms of the incentive? Semiconductors is the biggest, mobile and IT hardware, auto components is the third, followed by pharma and then food processing. The large segment goes to semiconductor, mobile and IT hardware because the infrastructure the government is developing is important for heavy goods to be shipped. But mobile phones, semiconductor, all of these don't need that level of infrastructure. So easily in an air-conditioned building of 10, 25 stories, they can house the entire thing, right? And they can be put into small packets and shipped out by air as opposed to heavy things. So those will come over a period of time. So the initial, they're trying to drive success through that which can easily come, even though our infrastructure is still not the best in the world. We are progressing there, right? That's to bear in mind, right? And then if you see that the fiscal deficit that the government is reducing, right? Right. The revenue and the capex are separately given here. You can see that the trend line of total expenditure is coming down, but the capex share is going up. So the government is trying to make sure that they don't spend too much, but whatever little they spend, they want to increase more on capex. I think it's a recurring theme that you need to bear in mind. So that's why if you see fiscal deficit, which went up to 9.2 during the COVID pandemic, has been steadily coming down. And we are promising by 2026 to try and target 4.5, which is what we said, which is what it was just pre to the COVID year. Before that, it was less, but just pre to the COVID year, it was 2019-20, right? COVID hit in 2021, right? But bear in mind, that is still above the pre-pandemic level, and we'll have to continue this even after 26 to try and bring it down to pre-pandemic levels, right? And this effort, right, is basically, I'm trying to tell you here, April to December, because those were the estimates for the year, 2 months yet to come through, right? But if you see the April to December, how they're controlling, right? What proportion of the April to deficit, if between 2018 to 21, they exceeded the full year between April to December. But since then, if you see, they have brought that as a proportion, April to December fiscal deficits are coming down. So right through the year, the government is consciously concentrating on making sure that it won't spend than what we promised, right? And where are they going to spend? If you see the breakup, it's fairly diversified with defense at 8%. Interest payments on already borrowing is takes away 20%. So effectively, the government is left only 80% discretionary expenditure. 20 is committed, right? And then they have to give 20% to the states. There are pension commitments. The finance commission payments are due. Subsidy is only 6%. Defense is 8%. Centrally sponsored schemes like NREGA are another 8%, right? So it's a fairly diversified basket. And if you see the smaller circle inside versus the larger circle, the smaller circle gives you the 5-year average. And if you can see, interest is the one which is 19 versus 20, but in all other cases, against the 5-year average, we are trying to keep it lower now. So the effort of the government to become a more disciplined, less spending government is very, very clear. These are very important from an FII's perspective, right? And the investment is projected to a record high of 35% in this current year. So the investment to GDP ratio is going up. That is, we are becoming a investment-driven economy, right? So where is this investment going? If you see, railways, roads, defense, housing are the main four. And if you look at the size of the blocks, you can see railways is a big part. It's a growing block over the last 3 years. Roads are a big block over the last 3 years, whereas defense is actually coming down as a proportion. And housing is also slightly, it's a very small portion. Others are also coming down naturally. So clearly the focus being on railways, roads, to some extent housing, right? So, and if you see now, they're depending on the tax revenues. So if you look at the breakup of the government's incomes, right? The inflows, it's not income, it's actually receipts. So if you look at there, the center's taxes, which is the largest part. And if you see there, that's hovering about 50, 51, that's gone up to 55 for next year. Next, the big item there is debt, the borrowing. So as you can see, the borrowing from 42 to 41 to 39 to 35. They are bringing down the borrowing of the government, right? And hence, if you see, within the income tax also, direct income tax is rising. So if you see corporate tax, that's the blue line. You see GST, that's the dark blue line. You can see GST is about 28%. It's more or less constant. If you see income tax, the red one, that's gone up from 27 to 30%, right? And you see corporate tax, right? That's at about stable at 27%. So you can clearly see the increase is coming from direct income tax, right? So more and more people are filing tax returns and paying more tax. That's good because it's diversifying the receipt source for the government, right? So for the past 3 years, consistently, the actual tax revenues have met or exceeded the budget estimates the last 3 years, which means that the efforts of the government to rationalize the tax structure, get more people into the tax bracket is all working very well. So their projections, they are beating every year. So even next year, perhaps you can expect a beat, right? And so if you now see GST collections for January, they were the second highest on record at 1.7 lakh crores, right? And the second aspect of it is the disinvestment, right? While the government just puts in a number at each budget, they actually don't disinvest that much. So I would say this is actually good because disinvestment is in a way selling the family silver, right? So they would keep it as last minute. If they don't have any other source, they will try and dilute some stake, right? So consistently, they have been not diluting as they promise every budget. So this time, in fact, they have brought down the target itself to just 50,000 crores. And the current year also, they've downward estimated to 30,000 crores. But even that, up to now, they haven't spent it. So most likely, they may not end up actually disinvesting even 30,000 crores this year. So government is not selling its assets yet. I think they will wait for a time when they really need it, right? And the reduction in subsidies, which is good news, it's a giveaway, especially in an election year, it is commendable that they are reducing the subsidies, whether it's food or fertilizer or petroleum, right? And hence, to summarize it, all the end is that because of all these, government is going to borrow much less. So this was viewed possibly by the debt market also because if government borrows less, that much more is available for the private sector to borrow. So they call it the crowding out effect. So that will become less. The second is that if government is going to borrow less, there's less demand for loans, then interest rates also can come down. So overall, whether RBI reduces rates or not, the medium-term lending rates can come down a little more and be stable if the government sticks to what they are saying, right? So that's why the bonds have been rallying and the rupee has also been stable in this context because that interest rate differential between America and India will remain stable, right? So in December, foreign investors pulled out. In January they pulled out of December, but you will later see. I will show you that domestic investor interest is coming in and supporting the stock market in a pretty way. From the economy perspective, the other thing is that credit growth in industry is coming back, which means industrial activity is improving and some amount of capex is probably starting. So the red line which tells you about the credit loans, they are going up. Of course, we all know that personal loans shot up, but recently RBI brought in certain risk weightages. So there's a slight trend down there and services loan growth continues to be robust, right? So we already saw this, the gross and net market borrowing. So summarize it, we will, as RBI governor also pointed out today, in 24-25, we expect our growth rate to be 7%, at which rate we'll continue to be the fastest growing economy in the world, right? So now when you move our attention from the economy to the stock markets, and we look at USA, so one of the things of the USA, why the USA is very important to the rest of the world, is almost 60% of the world forex reserves are held in dollars. So what happens to the dollar matters to a lot of countries from their sovereign wealth funds, right? And the Fed, as we know, talked about 3 rate cuts, while the timing of the rate cuts has tended to get shifted now because the economy numbers have come out a little bit stronger, but there are still 3 rate cuts expected this year. So there are 4 the next year and another 3 in the year after. So total 250 basis points of rate cuts. So the dollar which has generally been declining. But as I told you, recently there's been a strong good news on the US economy front. So the dollar, as you can see at the bottom, at the right end in the green line, you can see a small uptick. So the dollar is strengthening a bit, but the rupee has maintained its hold. So USD INR, if you see, 1 month, the rupee has appreciated 0.2%. 3 months also, it's appreciated a quarter of a percent, right? Whereas the US interest rates, because the dollar strengthening means the US interest rates, 1 month have tended slightly to go up, though over a 3 month and 6 months, it's still negative. So this is an ongoing story that the longer term trend of the dollar is a weakening story, but in the short term, it reacts to the good news comes from the US economy, the dollar will strengthen. That means interest rates will not decline, they will, on the contrary, go up. These are 10-year interest rates that I'm talking about. And the domestic 10-year GSEC, it shows you clearly that by the end January, it was showing a negative, but we know that about 5 basis points in February, post the policy, it has come back. So that's why the US stock market is turned into an extreme buy zone now, right? If you look at the bull bear indicator, and there is ample liquidity in the US to support such a stock market rally. There was enough cash lying before the Fed rate cut announcement. And so almost $20 billion flew into the S&P 500 ETF on just one day. And the target for the S&P 500 has been taken up now to 5,100. And because of this, now the equity risk premium, because there's so much money run into equity, that the risk premium has come down, which means that because of the rally, the attractiveness of equities, now the valuations have gone up, right? So from that, if you see clearly from a perspective, money has been flowing to India at the cost of China. This tells you the Chinese Shenzhen index and the India Sensex. You can see how they're divergent in their moves. It's coming down minus 40%, whereas ours is up plus 20%, right? And hence, flows into the market, FII flows into the market, right? In the white line tells you the Chinese flows, which are coming down. The blue line tells you the Indian flows, which are going up. So these returns are naturally being chased by flows, right? So now when you look at it, right, India's market capitalization is catching up with its GDP. And if you see now, right, for next year, the market capitalization is slated to rise and go past the 4 trillion mark, and the GDP also should follow suit, right? So as a result of this whole move in terms of the rates softening expected, the US stock market has delivered a strong double-digit return over the last 3 months, whether it's Dow Jones, NASDAQ, or S&P 500. Now we move to the Indian stock market and look at the first thing to know, of course, is who owns the stock market and who buys and sells. Ownership is largely with the private promoters, but they don't buy and sell their stocks. So if you take the rest of the market called the free float, almost 33% is with the FIIs, another 15% with domestic mutual funds. So now when you look at the composition of the FII money, about a quarter is long-term money and almost 2/3 is hot money, short-term money. So if you now look at the short-term money, there's a passive money where India's share in the passive index has been going up. Hence, the flows into ETFs have far outnumbered the flows into from active funds to India. So that's robustly going up. Second is the active overseas funds also. If you see 28% of the fund managers have said they are overweight on India. So some positive flows from there. The third aspect is that over the last since COVID, at the cost of Russia and China, India's share has gone up in active flows also. So then the hedge funds, which you look at, right, from a short-term perspective, they put money when advanced inflation comes down, interest rates come down, currency weakens at the home country, and liquidity is ample. So now when you look at this, inflation has been trending down the whole world. You already saw the fact that over 3 months, 100 basis points, the US 10-year has dropped rates, and the money which has been flowing into gold from the currency, you can see gold has been going up. And because of this, internationally, not just from US, there's enough liquidity available, around $25 trillion in the international market. And oil prices, which are a very key factor for hedge funds, because Indian economy imports 83% of its oil requirement, and hence there are 8 negative factors when oil is rising, which convert into positive when oil is falling. And if you see a longer term trend, FI inflows come in when oil price is falling and go out when oil price is rising. Right now, just after a decline, we are seeing a stable oil. So hence, hedge funds are now at this point in time not worried about oil in that sense. And so the trend in oil prices is one of a declining and stable. This is expected to continue till March 2025. So on that basis, you can expect that oil will not be an important decision here unless something dramatic happens in terms of the decision of hedge funds to put money into India. While at the same time, domestic MF flows, if you see, they have matched the FII flows step for step. In fact, since COVID, if you see, 60% of the flows have been domestic purchasing and only 40% is FII. So the domestics are increasing the share and the FII show has dropped from about 18% to 16.5%. And mutual fund AUM is actually overtaken FII AUM today in terms of the exposure to the market because of the strong mutual fund buying. And then if you look at valuation, let's look at the earnings first. So now if you look at the quarter 3 earnings update, you can see from the table on the left that the PAT growth for the Nifty 50, Nifty 100 is 20%, which is large caps are around 20% growth. Mid caps are at about 43%, small caps are 43%. So clearly, mid and small cap earnings, though fully the picture is not there. So the table below, 80% of large caps have reported the earnings, but only 60% of mid cap and 51% of small cap yet reported. So from this point of view, right now it's looking like mid and small cap earnings are coming out better than large cap earnings for the current year, which is one news factor to keep in mind. Within the sectoral, the EPS breakup, if you see, only the chemicals and fertilizers sector has shown a negative EPS growth so far. The green ones are showing very strong positive growth, which is automobile, cement and cement products, construction, industrial manufacturing, metals, oil and gas, and services are all showing strong EPS growth. Neutral EPS growth has been shown by consumer discretionary and pharma and healthcare at about 18 to 20%. And those which are dragging the earnings growth down with their very low growth are consumer goods, that's FMCG, non-banking financial services, IT, power, and telecom. These are the ones which are dragging the earnings pattern. So you can see that the market price movement of these sectors probably mirrors these earnings forecast that has come up, right? So from that point of view, still, however, earnings are beating analyst expectations broadly. 55% of the companies have beaten the analyst expectations, right? And hence, now you see for the year, Nifty 50 is probably going to hover around 20%, which is what this quarter has disclosed, right? So on that basis, if you see large cap valuations, India today, if you see, this is the world market. In that, the US is the highest valued market, emerging market is the lowest, Japan and the European index are in between. So India is trading at a 90% premium to the world markets, right? Whereas our average premium has been 57.7. So we are, at a high PE related to the world. So why are these FIs willing to pay a premium to India? The reason for that is that our market earnings projection, if you take the black line in the middle, so right from 2 years ago, we expected 917 EPS for Nifty. Today, we are expecting 943 EPS. So the expectation is roughly constant. So no volatility in the earnings. At the same time, the holding period of investors in the Indian stock market has rapidly expanded. And you can see that today, almost for 4 years, the domestic investors stays because of the SIP component. And if you see sovereign wealth funds increasing their share means even FIS is staying for almost 3 years. So the churn in the market is very less compared to earlier. Hence, the volatility of the Indian stock market is comparable, lesser than the world market and roundabout there. Hence, if you see from a beta perspective, India's versus emerging market, our beta is declining, which means our riskiness is declining. Hence, a premium is justified because just like in the domestic market, an FMCG stock with a low beta commands a higher premium. India is moving towards a low beta, which means you're moving towards being like an FMCG stock in an FIS portfolio of stocks. Countries are stocks for FIIs, right? So to that extent is where the premium gets justified. And then if you see, since they are investing at a premium, the returns also in Indian markets have justified this premium. Post-COVID, if you see, India and US are the best returns for those who came in during COVID. And you take a longer term return period, you can see that over 10 years, we have delivered 12.5% dollar term returns. And over 20 years, we have delivered, over 10 years, it's 7%. Over 20 years, it's 12.5%. So in that sense, from a longer term sovereign wealth fund, we have delivered a very good dollarized return compared to the interest rate levels in those economies. So their investment has been worth it. So this reinforces the fact that they willing to pay a premium for India's growth story. Right? Now, in a comparison to our own history, if you see, yes, we are trading at a slight premium over our long-term average. But we are nowhere near the premium that we were at in October 21 or where we were at in January 2019, December 2018. So we are slightly more expensive, but there's still some way to go for us to be really termed as too expensive to buy, right? When we look at the broader market, we all know that in this year, it's been mid and small caps which have rallied, which is what these data show you. And if you can see that there's not been that much difference in earnings if you take from the previous peak. But if you see the premiums as of the month of December, right, you had a 16% premium of the mid cap index and 10% premium of small cap index. That premium today is 14 and 22. So over a longer period of time, the earnings actually hasn't contributed, but it's the demand for stocks which has contributed. What is the reason for this? If you look at it, you can see that from a discount early in April, by the end of November, they had already both mid and small caps had moved to a premium. The reason for this is that the FIS was selling last year till March, suddenly came in over the next 5 months and brought in 1.6 lakh crore. This took up our valuations to very high levels, and hence mutual fund managers tended to shift the money from the large and mid cap or the flexi cap towards mid and small cap because large caps were getting very expensive. So if you see the concentration of the mutual fund universe, only 26 stocks account for 40% of the market cap. So naturally, when mutual fund managers were selling large caps to FIIs and diverting that money to mid and small cap, their prices rose much more because liquidity is so less in the mid and small cap, right? This tells you that from an index perspective, right? In the NSE 500 index, which is the flexi cap benchmark, 74% is from just 100 stocks and balance 400 stocks account for only 26% of the market cap. In addition to this, we've had some FII flows from Japan come in directly into mid caps, which has helped mid cap valuations go up. The third is, of course, that inflows from customers all have tended to be concentrated in the small cap space. As you can see here, over the last 6 months, these small caps have been consistently getting 3,500 to 4,000 crores of inflows. And hence, if you see, the diversification of the small cap investor base has also happened. It is now having the largest number of investor folios compared to large cap or mid cap. Something like 80 lakh new folios have been added into the small cap over the last few months. And hence, if you see, SEBI is looking at this as a risk, saying so many retail investors are exposed. So there is news that SEBI is going to widen the basket and make large caps to 150, mid caps up to 350, and then small caps, so that a lot of these stocks come into the larger indices and greater allocation of liquidity comes in and may help calm down the risks to the market, right? But apart from that, the reason that we are seeing this, one is we saw the earnings growth for this quarter, mid and small cap has come better. The second is that the SIP book, which has been growing, right, till last month 17.6, today the data has come, we're probably closer to 18. And then when you look at it and analyze the breakup of this is from just the CAM service there and in some of the MNCs. So this is for a 16,500 crores of collection. If you see there, I have circled there that in December, the share of mid cap plus small cap is almost 30% of the total SIP book. So out of 16,000 crores, 5,000 crores is coming to buy mid and small cap stocks in those funds. Then when you look at the flexi cap, large and mid cap, sectoral, which are multi-cap funds, another 12 plus 8, 20, 24, 33%, another 30% comes from multi-cap, where half of it can be allocatable to mid and small cap. If you assume that makes it 30 plus 15, 45%. So which is almost 7,000 crores of buying is coming in. In fact, if you see how decisively that has shifted, I have shown the delta share. So what it tells you is that the incremental SIP book from April to now, 30 plus 14, 44% of the incremental flows have been into mid and small cap. So clearly there's a big shift in terms of the flows into mid and small cap. And this has provided a protection because whenever there's any small correction, there is mutual fund managers are having the SIP installments to go and buy the stocks. So that's why if you see, the market has been taking small corrections in their stride at the same time, right? The larger, when the FIs also come in and buy, the mid and small caps also get bought because of the SIP flows. So that has provided a protection to the market from that. Today, 34% of the SIP flows are from SIPs and 34% of the active equity AUM base is also made up of SIPs. So That's the reason for the short term, right? In the long term, also, we are probably getting long term capital flows because long term funds, which come as a percentage of share of global GDP. So, in the economic outlook for the medium term, India's economy is set to triple thanks to manufacturing plus services plus consumption over the next 15 years. As a result of which, over the next 4 years, India is going to continue to be the fastest growing country, and we are going to all the position to go from the fifth rank to the third rank by 2027 of the world economies, and hence our share of GDP is expected to go from the 3% levels to the 4% levels, which means that sovereign wealth funds are also likely to allocate more money in the short term when they get clarity. That's where the budget was very important, because the reinforcement of the capex expenditure and fiscal discipline both mean that we will get this share of money also coming in fairly quickly, right? And the downside risk to our growth, because we are a domestic sustained economy largely, is also among the lowest. Next to Indonesia, we have the lowest downside risk. So the beta factor, which I spoke about earlier, means that we can get pension and insurance funds and sovereign wealth fund money also increasingly into our country. So hence the month of December saw a solid increase. 66,000 crores of money came in from FIIs in that month. But then come January, we saw some profit booking around the result season because there was disappointment from some sectors. And so in January, if you see, about 25,000 crores of outflow has been there, which is largely in the second half. So this started after the results started coming out because specifically certain companies reported less than expected results. That's why if you see end January, the large cap index actually is almost negative to flat. But domestic MFs have bought 22,000 worth of crores of stocks in January. Hence, since that is a more broad base, because the SIP book is coming in 30% to mid cap and small cap, you are seeing that the mid and small caps have actually delivered a 1 month return of somewhere between 5 to 7%. And over 3 months, that's actually a return of 23 to 24%. So the mid and small caps continue to sustain their rally because of these factors. And if you see overall within the emerging market space, India over the last 1 month still remains in a dollar terms, right? One of those markets which has positive returns, whereas overall emerging market index has delivered a 4% negative and China has delivered a 6% negative, right? Now, when you shift to the medium term outlook, what we need to have to look at is you got to look at the rolling returns because you got to look at the risk and the reward. So if you now look at it from a large cap perspective, you can see that investors who stay for 5 years and longer not only minimize their risk of capital loss, are also able to get higher probability of double-digit returns, right? So similarly, if you compare with the mid and small cap, you can see that the higher risk of small cap is not necessarily compensated at all times by a higher return, right? Whether you take it as probability of capital erosion or minimum loss or the average return or the double-digit return, large caps and mid caps have a much lesser volatility and much measure predictability of their incomes, right? So small caps, where they are delivering very well, have over historic periods not necessarily delivered returns just because staying invested for long, you get better returns, not happening. Why? Because when you then look at it, right, it's the risk capital of the customer when you take it into account and look at these small caps which are at the high risk element. What I would suggest is that you should put the money, even for an aggressive investor, within a combination of multi-cap funds, right? Obviously, flexi caps tend to have a larger proportion of large caps and have the flexibility to do so when needed. Large and mid cap are constrained that they can't put more than 60% in large cap, but minimum 35% in mid cap. Plus multi caps, more flexibility because 50% is in mid and small cap, 50% can be large cap. So if you spread your risk around this, you can take care of the risk reward equation, which I was talking about, that small caps, blindly holding small caps is not necessarily a good thing to hold for the long term, right? Now, when you move forward and look at it, right, how didn't you plan these things, right? I think the important thing with small caps is you have to time your entry and exit as per the business cycles, right? And it's not true only of small caps, even large cap you see. I've done this analysis for the Nifty, and if you look at it, the 10 years CAGR is 14.5%. But look how varied the returns, calendar year returns are. And when you then split those calendar into monthly returns, you realize that only 61% of the time over a decade has the large cap index delivered positive returns. Balance 40% has delivered negative returns. So monthly returns and yearly returns can vary widely, right? Because economic growth, which reflects in EPS growth, doesn't immediately reflect in the stock market because market rises in the anticipation of a good result. And the results come, if they're not expectation, the market actually corrects. So this happens because of the economic cycle. And even in the large cap, you see on a 5-year basis, you can see there are times when the large cap has delivered -3%, another time plus 41%. This is because of the existence of business cycles. Our economy has gone through 5 business cycles. The 5th one is currently running. So what happens in this period in a good cycle, like 2003 to 8 or 13 to 17, or what is currently going on, you see that the small caps do better than mid caps do better than large caps. You can clearly see in these tables as I've delineated. Whereas when you're in a not so good cycle, small caps lose the most money, then mid caps, then large caps give you the least loss or the best protection. So timing your entry and exit is critical here because of these cycles existence, right? Now, today we are in an early part of the cycle. So the optimism is there that the economy will continue, but we all know that the private sector capex is getting delayed. So we may go through a pause and then regather. So that's why it's important, like I said, that you trust a fund manager to do the shift based on the ground reality rather than individually take exposure into large cap, mid caps, and small caps, right? So because the timing of these is very hard to catch. The first good cycle lasted 4.8 years. Then the following bad cycle lasted 5.8 years. Then the next good cycle lasted 4 years, but the following bad cycle lasted only 2 years. Now this cycle has already gone 3.7 years. So getting it from a retail investor directly by a distributor, these kind of things are very hard to predict. So a fund manager with the fund with flexibility can manage this much better. That's why I was recommending that, right? So like you said, I've been showing you here, the risk of loss, right? If you have missed the end of the peak of a good cycle, in the very next 1 year when the market corrects, you can see that you can lose up to 70% in the small cap space. Whereas you catch it at the end of a bad cycle and the good cycle, in the 1 year, you can make 160% returns. This wide variability in that 1 year return means that the timing of your switching is absolutely critical, right? That's where multi-cap, flexi-cap, and those kind of funds are better positioned to protect you from the downside, but also try and capture the upside, right? So from that point of view, right, if you take from a moderate risk perspective, one simple answer is to take a longer term perspective because those fluctuations of the business cycle tend to get smoothened. So here, if you see, this is the nominal GDP growth of our country. It's by and large gone up, except during COVID, you saw a correction, right? Absolute GDP. Now, when you see the market, the same stable increase in normal GDP is not followed by the market. It goes through ups and downs because market anticipates, then anticipation doesn't get delivered, corrects, or it does better than anticipation, then it goes up. So when you match the two together, you can see that if you hang in through this whole period, the market catches up with the economy. So from that point of view, right, markets always tend to deliver better than the nominal GDP when you wait for a 15-year period. Like this 15-year period, market delivered 9.7, nominal GDP was 8.4. It's not true only of India. South Korea, China, all if you see, provided you wait it out for a 15-year period, you can generally then correlate that the economic growth will translate into your stock market return, right? So from that point of view, right, staying long term is one solution for any investor by choosing these kind of flexi cap funds where the manager manages the volatility, but over a period of time, you will be almost certain of getting the nominal GDP growth in your portfolio. Now, when you're a more conservative investor, then obviously you need to take off that equity risk and temper it with other asset classes. So what I've shown here are the 4 types. Most of these, there are 3 asset classes in play. There's equity, right? Then there's arbitrage where you hedge the equity. So it gives you somewhat debt-like returns, but there's an equity taxation that helps. The third is pure debt. And the fourth is gold as an asset class. So this blend, right, if you see, fits in the middle of the risk reward package, right? So these investors, what do you want? A moderate risk investor wants a long-term inflation and fixed income beating return with a lesser risk. And if you see the mutual fund industry, aggressive hybrids have delivered 11%, BAV 10.5%, and equity savings 7.7%. So by and large, they have delivered that inflation beating, FD beating return. Bear in mind, all of these carry equity taxation, so only 10% taxation. So for a moderate investor, these are the categories. The new category which has come up is the multi-asset. As you can see, it has been gaining popularity. Month on month, there are more and more flows going. What happens is These multi-assets, for example, over the last 1 year, 3 year, 5 years have delivered very good returns because all the asset classes have done well. Equity has done well, and the third asset class is gold, which is most of these multi-assets has also done well, right? So when you then look at it, multi-assets are basically carrying at least 10% of each of these three. So 30% is locked. The balance 70 can be put into various types of things, right? So multi-asset funds are broadly in a risk parameter around the BAF, but can have the potential to give a better return. So this gold that is added is important that you understand gold as an asset class, because enough has not been made to study and explain about gold. So I'd like to take a few minutes to explain gold to you all, right? So you see here the calendar year returns. You'll be surprised to know that over the last 13 years, if you take equity, debt, and gold, there are 50% of the years gold has been the best asset class. I'm sure a lot of you are surprised by this, because what happens is that historically performed, gold absorbs shocks. So when equity goes down during a shock, gold actually bounces back. It happens like during recessions, when equity corrects, gold goes up. It happens during extreme shocks like COVID or Russia-Ukraine conflict, when equity goes fall down and gold goes up. So this comparison tells you then that if you compare over the same like-to-like period, when equity has given negative returns, gold 90% of the time gold has given positive returns, right? Another 6% has given negative, but less negative. So 97% of the time gold has protected you when equity has come down, right? But at the same time, when equity is giving positive also, 36% time gold has actually beaten equity. So gold is a good asset class to combine. So multi-asset funds are gaining popularity because for a moderate investor, when equity is correcting, you have this asset class which comes in and absorbs the shock and thereby gives you a much more stable. And sometimes when equity is doing well, gold also is doing well. So these two factors make gold a wonderful class to add as for a moderate investor into your portfolio. So if you see the combined of the previous two slides, almost half of the time, 40 to 50% of the time, gold has beaten Nifty over a longer term period. So which means that as an equity investor, it's good to always invest in paper gold because it acts as a shock absorber, right? And not only that, gold also gives you diversification benefits over a lifetime, because in a cycle of an economy, there are times when equity does well, there are times when debt does well, there are times when gold does well. So when you hold for the long term, sometimes the gold will come to your help. Right. The other thing about gold is that living in India, the rupee depreciation when it takes place reflects in the domestic gold prices. We can see the component of the rupee depreciation in domestic gold prices in this table. And over a long period of time, if you see, rupee has depreciated almost 3% per annum. But in shorter periods like 3 years, 5 years, and 10 years, those bouts of depreciation can be as high as 5 to 7%. So that's when gold being present in your portfolio automatically will take away the pain of that loss by giving you an additional return to the extent of depreciation, right? So with that, I have concluded. Thank you very much, friends.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.